Welcome, small business owners and accountants, to an essential discussion on S-corporations and reasonable compensation. An S-corporation allows a business to pass its income, losses, deductions, and credits through to its owners, avoiding corporate income tax. However, if you're a shareholder employee, the IRS requires you to pay yourself a reasonable compensation via W-2 wages before taking any distributions. This is crucial to prevent S-Corp owners from minimizing payroll taxes, as wages are subject to FICA taxes while distributions are not. The IRS defines reasonable compensation as what would ordinarily be paid for similar services by a comparable enterprise under similar circumstances. The IRS does not provide a rigid formula, but outlines key factors examined during an audit to determine fair market value. Your educational background, certifications, specialized skills, and professional experience all contribute to your value. The complexity, scope, and significance of your duties and responsibilities, along with your decision-making authority, are critical considerations. The number of hours you work and your level of involvement directly impact what constitutes reasonable compensation. Your salary should be comparable to what a non-owner employee in a similar position would earn in the same industry and geographic area. Resources like the U.S. Bureau of Labor Statistics and industry-specific salary surveys provide valuable benchmarking data. Company size, complexity, and profitability also influence what is considered reasonable compensation. Many S-Corp owners unintentionally make common mistakes that can trigger IRS scrutiny, primarily revolving around underpaying themselves. The most significant red flag is low salaries combined with high distributions. For example, paying yourself $30,000 in salary while taking $100,000 in distributions is highly likely to attract an audit. Paying yourself nothing at all is an automatic audit trigger if you perform services for your S-Corp. Also, assuming the 60/40 rule is an IRS guideline is a common misconception. It offers no protection during an audit. Failing to adjust your salary as the business grows is another mistake, as a reasonable salary in early stages may become unreasonable later. Disguising compensation as loans or gifts without proper documentation can also lead to reclassification by the IRS. Getting reasonable compensation wrong significantly increases your S-Corp's audit risk, with the IRS focusing more on compliance. The most common and costly consequence is the IRS reclassification of distributions as wages. This leads to back payroll taxes, significant penalties, and interest on the underpaid amounts. Audit triggers include zero or minimal wages for working shareholders and large distributions with disproportionately low salaries. Inconsistencies between S-Corp and personal returns and a lack of formal documentation are also major vulnerabilities. To minimize audit risks, small business owners and accountants should adopt several best practices. Document your compensation thoroughly, including job descriptions, comparable salary research, and the rationale behind your decisions. Conduct annual reviews and adjustments, especially if your role changes or the business grows. Always prioritize W-2 wages before distributions, ensuring you pay yourself a reasonable salary regularly. Seek expert advice from a qualified CPA or tax professional specializing in S-Corp to help determine a defensible salary. In conclusion, understanding and correctly implementing reasonable compensation rules are vital for compliance and avoiding costly IRS audits. By proactively documenting your compensation and seeking professional guidance, you can confidently manage your S-Corp and ensure its long-term financial health. Don't let a misunderstanding of these rules jeopardize your business. Take action today to review your compensation strategy and protect your S-Corp.